Okay, everything seems to be working fine. Cool. Welcome everybody to this webinar where we are going to talk about supply and demand, a fascinating topic. And I've made a presentation, and this is a presentation I've done. Michael, I'm just going to mute you because I can hear myself echoing.
Yep, fine, that's fine.
Okay. That's better. So this is a presentation I did for FX Street, and I've changed it and updated just a little bit based on some newer material. So we'll just walk through this, and then we can have perhaps a Q&A at the end. And you guys are also welcome to ask questions during this presentation. And it's going to be pretty practical as one. So we're going to talk about a bit of theory, then we're going to go to the charts and kind of go back and forth there, because I think that's just a pretty good way to get people used to it. There's still a lot of people at the door. Let's let everybody in. Okay, cool. All right. Well, this is a presentation on supply and demand, and supply and demand is something that I think a lot of people try to overcomplicate to perhaps scare people a little bit. So they think, oh, supply and demand, you have to study it for 10 years, and funnily enough, the people that tell you this will have a really expensive service, and it'll take you 10 years of subscriptions in order to get you to study supply and demand. But the good thing is that's not necessarily true. Supply and demand, using some very simple principles, is actually pretty easy to understand once you've trained your eye. So it does require an initial bit of chart time, but I think that you'll find that after a couple of months, a few months of and maybe even shorter, sometimes a few weeks of chart time, then you'll start to see these things, and then you'll get a lot of these moments. Okay, and then you'll see these things, and then things will all of a sudden start to switch on, and that's when the magic starts to happen. That's when you are able to find these levels where price races to your entry. You're a little bit nervous. You've got the limit order in there. Oh, will it stop? Will it stop? It comes to your entry. It pokes it. It goes 1 pip against you, and then it goes up 60 pips. And that's the beauty of a supply and demand, is because when you've learned to spot these areas, they just leap out at you, and they give you incredible risk-reward trading opportunities. Okay, super. So let's move on. So the overview is we're going to talk about what supply and demand is, and we discussed some of this during the last webinar, but I'm going to go through everything again because this is about supply and demand. So I want to deal with the topic in its entirety. We're going to talk about accumulation, then we're going to talk about analyzing a pair chart, and this we can do in 2 different ways. We can do this performing a complete analysis or a full analysis, and we can do it using a short, quick analysis, which is something that you'll learn to do very quickly once you've gotten used to supply and demand. Okay, so what is supply and demand? Well, supply is the quantity of a product or a service available. And then we have demand, which is the opposite, so the quantity of a product or service that is in demand. And so as traders, our job is to be able to identify the imbalances in supply and demand on a price chart. And so, I mean, you're shown a price chart like we have here, so we have to teach ourselves to see these imbalances in a price chart. With a bit of practice, they'll start to leap out at you. Okay. And so how do we identify supply and demand on a price chart? Well, you want to see areas of supply and demand that exhibit great strength, because this tells the story of price imbalances. And when I say price imbalances, I mean that we have a very strong imbalance in supply and demand. So we either have much more supply than demand, or we have much more demand than supply. And this is it becomes very clear on a price chart. And so you want to see a lot of strength, a lot of follow-through on moves on the price chart. If we go back to this chart here, you can see that these green candles show us exactly that. You see this candle left, and this is a very strong move. This is also a strong move here, and we have these relatively strong moves here all over the place. We have another one here, and so these will start to jump out at you even when you don't have the indicator on the chart. And so, I mean, how can you qualify and identify these areas? Well, typically you will use I have three different methods for doing it. We're going to focus on two because the third one is less useful than these two here. These are the two most powerful ones, so we're going to focus on the stuff that we know works very, very well. So the first one is the consumption of opposing supply and demand. And when I say opposing supply and demand, of course, it has to be qualified supply and demand. And this is actually paramount, because if you're assuming that an area of supply and demand is qualified and it isn't, that breaks the whole system, because these areas are chained together when you perform your analysis, as we'll see shortly. So it's really important that you get this bit right. And then you have a market structure failure. Well, first of all, what is market structure? If we look at a price chart, and if we want to, in some way, make sense out of this, what's the most traditional way to decide the structure of a market? Well, typically, we'll use trend lines. And so you can get a trend line from here. You can put it up there like that. You can see that we have a trend line that goes up like that. So we have an upward sloping trend line. The lows on this move, we can maybe take this one here. You can see that they are more or less being respected as price continues moving higher. And so this trend line will become a reference point for price in the future. And so when I say market structure failure, that's when this trend line has been violated. So we have big, strong moves or closes that break the structure of this trend line. So, for example, now if we had a really strong push below, so we had a big green bar that moved down here, that would violate this this trend line, ultimately breaking the structure of the market, which is great, which is what we want to see. And I'm going to go into detail with all this shortly. Okay, so if you look at the first one, consumption of opposing supply and demand, what does that look like on a price chart? Well, we have a really nice, clear piece of a price here. You can see price came down here. We had the accumulation, then we had that green candle, which is a beautiful, really nice, strong move away. So price left, and it moved higher. When price left here, we managed to move above this high here. We have a little red X here. So this is the daily chart. When price left here, it was able to consume this daily supply here, which is why there is an X. Before price moved above this high, there was a red check mark there, but as soon as price managed to move above and beyond it, then it's changed to an X, and that just simply tells us that this area of supply has been consumed, so we cannot consider it for a trade at a later stage. Okay, so price goes up there, that qualifies this as demand. Price sells off, we accumulate, we sell off, we have a nice green candle that leaves this area of accumulation, and price moves lower, and eventually it moves below this area of demand. You can see before price had moved below this low, there was a red check mark, but now it's turned to a cross because it has been violated. And then you ask yourself the question, okay, consumption of opposing qualified supply and demand. This is qualified, why? Because when price left here, we were able to consume opposing supply, which is up here. This is micro supply. This is not beautiful supply, but it is micro supply. We have the parent, and we have a couple of children here. When price left here, we managed to move through all of them, consuming all of liquidity up and around that area. Okay, so price left, we accumulated, we sold off, and then we had a period of accumulation here, and then price managed to stab through here and consume that. What does that do? That tells us that the opposing area of supply that was capable and responsible for consuming this one, this area of demand, becomes the one that we trade. So before price manages to move below here, we trade this one. Price came down, it poked into it here, we had at least a one-to-one here, we had a nice reaction, and then it's been removed by this one. Then you ask yourself, what area did it? This one did. And so this is the one we trade. Price came up to it roughly, and it held, and price managed to move lower from there, also located at the big figure. So this is just a really nice, clear example of supply and demand consumption. And we're going to really drive this point home via a bunch of examples here shortly. Okay, and then we have this one here. So this is a market structure failure. We showed a brief example on a previous slide. And here we have a horizontal trend line. So you can see the price tested these lows for a period of time. You could have probably moved this trend line up a little bit higher. And then we had this trend line here, this diagonal trend line here that has been broken, just in the same example as we saw just here. We had this trend line just here. Okay, and so price managed to consume or violate this horizontal trend line and this this diagonal trend line. So you ask yourself, what area of supply did that? Well, this one did just here. This is the one that did it. This one caused the break of this sloping trend line and this flat trend line. Very nice. It's a really nice example there. Okay. Okay, good. So let's keep moving on. Okay, so I mean, we have these supply and demand, these areas of supply and demand everywhere on the price chart. If we have a look here, you can see that, I mean, they're everywhere. We have something here. We have a green candle, some accumulation before it. We have another one here, another one here, another one here. I mean, they're everywhere. You can see they're absolutely everywhere. And so it's very important that you are able to qualify these areas of supply and demand, and you want the areas that are really, really good. So you want to choose only the best possible areas, because these are the ones that are most likely going to hold. And how do you do that? How do you choose the really good areas? Well, I've made a checklist that I help me assess if an area of supply and demand is good or not. Then there's something called the parent-child relationship, which we can, you know, we're just going to deal with these individually now. And a parent and child relationship is simply, it's terminology that I use to help people understand that there is a relationship. There's a relationship between a parent and a child, and so there's a relationship between parent and child supply and demand. And if we have a look here, you can see, let me zoom in once, you can see that just here, we had this area of micro demand. Price went up, it came back down, and then we accumulated, and then we went up again. This is a child demand because it's a reaction to this one. So these two are related just here. This is a child, and this is an older sibling, and the parent is actually all the way down here. So these are all linked together based on if they have reacted on each other or not. And it sounds a little bit complicated, and you kind of, when you start off, you'll be doing this analysis kind of keeping your tongue in your mouth and really kind of focusing, but it becomes pretty clear. And there's some simple rules. You can see if an area of supply or demand is established independent of any other area of supply and demand, then it's a parent. If it is established as a result, rather as a reaction on another area of supply and demand, then it's a child. And I think, I don't remember which pair it was on. Yeah, this one here, here's a nice example. Here we have this area here. This was established pretty much independent of any other area. When we're testing these highs here, so we're testing, we have some resistance up here, but this one here is established as a reaction to this one. What does that tell us? Well, that tells us that this is supply and this is a reaction to supply. So this is not supply, this is a reaction to supply. This is the supply and this is a reaction to it. And so by asking, okay, so when you look at an area of supply and demand on a price chart, then you can ask yourself, okay, here we have an area of supply and demand, great. Then the next question you should be asking is this a parent or is this a child? So we go back to the checklist, then you start from the top. Is this a parent or is this a child? Then you do your analysis and you decipher if it's a child or a parent, and if you can answer it's a parent, then that's good. If you say that it's a child, then you have to find the parent. And once you've found the parent, then you found the real area of supply or demand. So here you can look at it, you can say, okay, is this a parent or is this a child? You say, this is a child. Okay, where's the parent? Well, the parent is located just above here. Okay, good. So that means that, we could sell here, but the better trade would be to sell here. And this makes perfect sense because, when you're trading, you want to make sure that your stop is located in an area where it is protected. So let me do a little drawing here. Okay, so if we have something like this. So we have, so this here, this is a liquidity, just here, we'll make it an L, and this is price here. I should make a graph for this. And so when you have, for example, a really good parent or a really good area of supply and demand, you're going to have these pockets of liquidity located in and around these areas. So, for example, when price is coming up here, let's say the price comes up here, this here is going to have, sorry, I made this all wrong. This should be liquidity. So price will be moving up like this. So this here, there's not a lot of liquidity here. You can see how price moved very quickly. So there's a pretty thin market just here. So the liquidity is thin. But when we get up into these areas here, we're going to see liquidity increase. So at point 1, liquidity is going to increase. Then it's going to kind of go down as we move between these 2 points. And then when we go to the next one, the parent, it's going to go up like that. So we have point 2 here. And so what you want to do is that you want to, when you put on a trade, you want to find an area that enables you to put your stop somewhere in the market where there's protection. And yeah, there is protection above this high here, so putting your stop here, but there's much more protection over here, which ultimately puts it up here. So you want to find these peaks in liquidity and ensure that our stop goes on the other side of them, so the price is going to have a very tough time of reaching it. It's going to really have to grind in order to reach the stop that is located up here, in contrast to the stop that is located here. Why? Because price has already been back to this level, and so it's only going to take a short spike to reach this next pocket of liquidity. But the real pockets of liquidity, the good stuff, is located above these swing highs here, like a considerable hop above that. And then you're going to have these really nice pools of liquidity, these massive limit orders located in and around these areas. Okay, Derek is asking, do we only want to trade on the parent? It depends, because you can have really nice child supply, supply and demand, but you can also have less than, like, suboptimal supply located at the child. So it depends. It always, yeah, that's a bit of a crappy answer, and I apologize, but it depends. I mean, you can take this. You could take this easily, but you would want your stop to go above the parent. So you could take it there, and then you would have a 30 pip stop, or you could say, okay, well, I want to wait for the parent because price has already been back, and then I can save 8 pips. So a lot of people will take, remove that. A lot of people are going to take the child if it's a really nice, well-structured child. Again, using some of these here, or sorry, and they'll take that, but their stop is going to go above the parent. And that's just a really good idea, just to ensure that you put your stop in the area in the market where price is going to have a tough time getting to it. Okay, super. So there's a little bit on about the child and parent supply and demand, and sometimes they can be a little bit tricky. And if you're looking at an area and you're having a difficult time assessing if it's a parent or a child, just pass on it. Just don't force it. If you can't, if it doesn't jump out of you, then you should really just leave it alone. Okay, Cecilia is asking, does the software only show the parent? The software shows like high quality areas, be them a parent or a child. You can see this one here. Here it found the parent. Up here it found a child. The parent is up here, but it's also marked the parent as an area as well. And so this is a decent area, and this is a decent area because price has not been back to it since. It had an attempt to come back to it, but there's still a small gap here. Price, this is not a good area because just previous to the establishment of this this child supply, price managed to poke up there. So I mean, price was up here and it went down, and pretty quickly it went up and then went down again. And so this is not a decent child area. It might work, but it might not. And so the higher probability trade would be to put it at the parent, or just ensure that you have your entry at the child and the stop above the parent. Okay, cool. Let's keep on going. And then we have the move away from accumulation. This is the second point. And I'm putting these in the order of importance. This is pretty important stuff. So the move away from accumulation. Okay, let's find a really, really nice strong area of supply and demand. Actually, there's been a lot on the Aussie recently. Okay, so if we have a look at, let's look at the daily chart, and if we have a look at, let's have a look at this one here. Then you ask yourself, is this a nice move away? Well, first of all, we'll start at the top of the list. Is this a child or a parent? It's a child because it's reacting on this weekly / daily area of demand over here. And this is actually also a child. The parent is over here. So this is a child, this is a parent, this is a child, and this is a younger sibling. And I apologize for these terms and younger siblings, but it's just to help one understand the relationship between these levels when you're performing the analysis. And so you can see that when price came down here, then you would ask yourself, how did price leave here? What damage did it do to the market? You can ask that question actually. What damage did it do to the market? And this is when trend lines come in, because you have the structure of the market. So you say we have a properly qualified area of supply, 2 of them here, and so we can draw a trend line. I'm just going to draw this in now. So if you want to draw a trend line, you have to choose swing points properly. Here we have the first one. This is great. This is qualified because it's kind of like an all-time high. Then price went down and it went up, and then we have this second one, and this one we can use as well on our trend line because when price left there, it took out this low. So this is good, and this is good. But if price does something like this instead, if price went up, down, so we had 1, went up, 2, and we have the low here. If price went like this and it's kind of messing around here, then this is not a valid swing, so you couldn't do that. If price had not moved below this low, then you could not use this as a trend line point. Then you couldn't even draw the trend line there. So that's super important. And so the only reason that we can draw the trend line there is because price managed to move below that previous swing low. So we can go like that. Then you can ask yourself, okay, how quickly and how strongly did price leave that area of child demand? Then you ask yourself, okay, what kind of damage did it do? Well, it actually broke a downward sloping trend line, which is really good. This is very good. And you can see here as well, we have the currency strength histogram telling us that this area was going to hold. Additionally, when it left here, it broke the trend line. So price accumulated. We have a small continuation pattern in here. It rallied, it accumulated, it rallied, it accumulated on the trend line, and then it cut away. And so you want to find the area of demand that broke the trend line, which we have a couple just here. We have one here, and then we have a small one just above it. And so this is a decent area because it managed to cause market structure to failure. So the whole move originated from this child demand, and we have a few independently created parent demand here and a child just above it. And so yes, price left this area pretty well. You can see price has not been back since, and that's great. Price really had a move up since it left here and has not been back. So price really left nice and strongly. Ideally, you want to see something like this, where this is a beautiful area, how price rallied, we accumulated for one period, and then we had a really strong 1 bar, or maybe 1 or 2 bars like this. So let's say that price left and went another leg down. Then this tells us that there's an incredible amount of supply up here and only a limited amount of demand. And so, I mean, this would be a very nice area of which to sell. We managed to break this. We can also draw our trend line, which looks like that because it went below here. So this is just a very nice area. Price left strongly here. It left pretty strongly here. Excuse me. And so things look pretty good there. So we had a really nice release there. We had a decent release there as well. Okay, and then we want to look at the structure of accumulation. And what does that mean? Well, you have messy accumulation, then you have clear accumulation. This is very clear accumulation. This is messy accumulation. This is messy. This is clear. This is clear. And this is clear as well. And so you want to find areas of accumulation where there's a very clear pattern. You can see we have another one here. Price rallied, accumulated rallied. We had that nice push away. This is a pretty clear area just here. This is a child. The parent is down here. As a matter of fact, this is a child. This is an older sibling, and the parent is down here. And here we have 2 periods of accumulation. This is really good. Here we had 3 periods of accumulation. That's also fine. What you don't want to see is 6, 7, 8, 9, 10 periods of accumulation, because this tells us ultimately that supply and demand are in agreement. They're balanced. This trading supply and demand means that we want to see an imbalance in supply and demand. We can see that here. We can't see that really here. We can see it here, how price rallied, accumulated, and then sold off. This is nice. This is terrible. This is kind of messy here, as you can see. And so ideally, if we focus on this little one here, when you see something like this, you have to look lower, and you want to find the areas of accumulation that are at the source of the move. And there's a little series of questions that you can ask yourself when you're performing an analysis, and that is, when you look for the green candle or a candle that leaves the area of accumulation very strongly, and then you go back one, and then you ask yourself the question, is this an accumulation candle? Yes, it is. Good. Is the range of the body, is the body of this candle within the range of the previous candle? Yes, it is. Which brings you to this candle. Is this an accumulation candle? No, it isn't. Good. So the analysis stops here. So this is our supply here. So that's the area that we would trade, the 75.25. But if we have something like this, we have a green candle, accumulation, yes. Is the body of this candle within the range of the previous? Yes. Are you an accumulation candle? Yes. Is the body of this candle within the range of the previous? No, it is not. What does that tell us? Well, that means that it tells us that we have a micro continuation pattern in here. So even though these are all white, painted white, there's a lot more going on in here than we can see. You can see that you see the close of this candle is lower than the low of that. That means the price went down, it accumulated, and then it dropped again. So there's a small continuation pattern inside this candle here. This is nice. This is nice here, but you can see that this is a child, and the parent is up here at the top. And this is pretty messy because price has already been back to this level previously, and so this is not a nicely structured accumulation. Okay, if we have a look at another area, let's try and scroll back a bit and see if we can find something. You can see this is an okay area. Our price sold off. We rallied a little bit, we accumulated, and then price left. This is okay. This is also nice. Price sold off. We accumulated for 2 periods, and the body of this candle is in the range of the previous. So these are related. These are they are part of the same accumulation. Let's find something that's not so pretty. Let's go back a little bit more. And you can see here, I mean, this is not terribly pretty, even though we can answer yes to those questions. Here we have the green candle. It's accumulation, yes, is the body of this candle within the range of the previous. No, it isn't. So this one and this one are not related. So this is accumulation, an area. This is actually child demand, and this is the parent or the older sibling down here. Is the body of this candle within range of the previous? Yes, 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 yes. So we would actually draw this area like that. So this is the area we would trade, and you can see how price is drifting higher. What does that tell us? Well, that tells us that there's going to be a micro continuation pattern in here. There's going to be a lot of children within this sideways drifting higher of price, as you can see here. So this is not a pretty area, and this requires us to go to the smaller time frame in order to refine our entry. So the structure of this is not that. So ideally you want to see fewer candles is better, no more than about 4 or 5 ideally, and you want to see a sharp move up to an area of accumulation, nicely formed accumulation, then either a move higher or lower, and the opposite for the other direction. So that's pretty important. Okay. Okay, so if there's any questions. Okay, Hayden is asking, taking the parent allows more reward, the risk than the chart, that's correct. So if you take the parent, then you have a smaller pip risk, and the market only has to move, well, it has to move less in order to reach your target or to get proper risk reward. Parent, in my experience, allows more reward and better risk management. Would you agree? For the most part, I certainly would, Hayden. I really would. Michael is saying, why isn't the parent on this example the bottom pivot of this chart? Not exactly sure which one I was referring to there. Okay, let's move on to the next point, the period of accumulation. And so the structure of accumulation means that you want to see the body of the candle within the range of the previous. That's pretty important. And so we have this next point here, which is the period of accumulation. We've kind of already touched upon that, but you want to see few periods of accumulation. Few is good. 1, 2, 3, 4, 5 is good. 6 is also okay, but like 8, 9, 10, that's not so good. And so this is really not nice, because you see when price is doing this, drifting up and down, creating these accumulation candles, it's also consuming liquidity up here as well. So if you consider this, how price moves down, we accumulate, then we cut away. Here, price isn't cutting away, it's moving up, it's accumulating, it's moving up, it's moving down, so it's trading in and around. So price is moving up and down, and that is essentially emptying these pockets of liquidity that we would use to ensure that we have a higher probability trade. So fewer periods of accumulation is definitely recommendable. Okay, and then we have this one, the anatomy of the swing. And the anatomy of the swing is an interesting one because it's pretty essential for many reasons. For one of the reasons is assuming that we want to buy. Let's say we're looking to buy at demand. So you want to look at this down here, and you have to also consider that if price, assuming that price was just left this high just here, so we draw the fibs from here to here, and I don't use fibs, but I'm just using it in this example just to show you where we could consider a place to trade, just to show us the depth of the curve. Okay, so you see that we have this, this area of accumulation here, and while we had a really nice release, it's really close to the top of this move, and so it's a very shallow area to take the trade. Price left, we had a nice reaction there, but if you're waiting for price to turn around, it's not advisable to take it when we're expecting a reaction at a point in this swing that is very shallow, and this is very shallow. Anything lower than, I'd say, 50, 38, at least 38 is simply too shallow. These 23%, they're really not a good idea. As a matter of fact, we could just remove that one there because we don't need that like that. So you want to focus on at least 38%, ideally the 50, the 62, and the 79. These are the really nice deep pushes that we like to see. And so we have the depth of the curve, which is important. This is also a part of the anatomy of the swing, but also we have these small areas that are located here. This is very important, and so you can see these little price nodules located on the leg that the swing is standing on, and then you have to ask yourself, where has price not been back? Where has price not been back to since it left here? Okay, let me zoom in a little. If you look at this, when price left here, when we form this decent area of demand just here, I'm just going to draw this in. Looks like that, roughly. Then when price left, we managed to move, we accumulate, and then we left. So if you look here, you can see price has already been back since the establishment of this area of demand. Price poked back into here. So you wouldn't want to be paying a price any more expensive than that. But if you look lower, we can move that even lower. We can move it down to here. And still, we can move it down here because price poked into this area on the way down. So you wouldn't want to pay a price any more expensive than 73.33 for this. And if we go to a smaller time frame, you're going to find an area that is nested within it, and that's the next point that we'll get to in just a second. But another thing that's very important is if we want to buy, assuming that we want to buy somewhere here, we have to make sure that there is enough room for the trade to materialize. You can see that we have this decent area just here. So you want to look, assuming that we would buy somewhere here. Let me put it in a line. Assuming that we would buy around here. Before you put in an order to buy, you have to look up and you have to ask yourself, okay, what does the road look like on the way to my target? So you have a target, a fictitious target of, let's say, 1 to 3 risk reward. Is that plausible? Is it possible for price to get to your target? And if you see this, if you see price move down, accumulate like this for a short period, so we have well-formed accumulation, we have a short period of agreement in supply and demand. So assuming that it accumulates for this period, maybe one more, then it pokes down into our entry. What do we have to look at this? This is the anatomy of this swing, and we have a bit of a problem here because we have a really nice area of supply that is formed just above our entry. What does that tell us? Well, that tells us that price, once it reacts here, is probably going to come up to this area of supply, then come back down to our entry. So you can, 1, set it and forget it. You can, 2, you can manage it and move your stop to break even once you get a slight move. Or 3, you can wait for price to take out this area of supply, opposing supply, to ensure that the road has been cleared to your target, which would be located here. So you want price to clear the road. And if it doesn't clear the road, then you're going to have to stomach these retracements back to your entry, and they are a pain in the ass. Just to say, it requires a character to have received 60 pips and watch the market take it away from you, so you give it all back and still hold the trade because you believe in your levels. And so it's best to plan it accordingly and just wait for the road to get cleared. We have this area here. It's not qualified yet. It's not well formed, but it could be. And if it is nicely and well formed, then you might want to manage this aggressively until this is taken out, or wait until it is taken out and then buy the green candle that leaves the area of accumulation that is responsible for consuming this supply, which is the opposing area of supply. So then you would walk. I hope I'm not going too fast. If I am going too fast, please stop me, because I have a tendency to kind of ramble a bit. And so we have the parent, we have a child that's reacting. So this is the second time back. The first time back is just here. Price comes here, we test. We manage to move through here. So we would have had, assuming this is properly qualified. So we would have that area as established, and then price comes down. We form an area of demand just here at the edge. When price leaves here, it's able to consume this area of supply. So we remove this one. Actually, we move the box from up here to down here because this is the one that did it. And when that happens, there'll typically be a green candle that leaves, and this is the one you buy, which enables you to reduce your risk. Your entry is here, your stop is just below here. So instead of being 60 pips, we can move it to, what was it, 27 pips. So we have a half the pip risk, and so price doesn't have to move that far in order for us to get a pretty decent risk reward on our way to essentially our target, which would be up here. And so it's when I say the anatomy of the swing, it's actually a whole lot of points, because it's, first of all, the depth of the curve. How far has price retraced in order to get to us? The further it has to retrace, the better. Number 2, are there any bumps in the road that could prevent our trade from materializing, from reaching our essentially our target, which is up here? And so there are a few different points in this point of the anatomy of the swing, but I covered the most important ones there. Okay, William is asking, when you say consume, you mean reach and come back down, or pass through and come back down? I mean pass through. So really good question, William. If we have a look at, we go on the 1 minute chart. Okay, you can see, then again, the markets are kind of quiet at the moment because we're getting late. But if you look at this area down here of demand, once price moves through it, then this one would have been consumed and the software will remove them from the chart after about a minute. And so that's what you want to see. You want to see price consuming this should it react here. And when price moves through it, which means that it moves beyond the high of the area of accumulation, then it theoretically or technically speaking has been consumed. Good question. Thanks for asking that. Okay, super. Okay, now we have the nested areas. What are nested areas? Well, these are also great because they enable you to get a much lower risk, pip risk for a trade. And if we focus on this, you can see the price rallied, we accumulated, we rallied. Not a really nice release, but we had a release nonetheless. We had accumulation at the edge of the area, and then price went up. But I bet you if we go into the maybe the 4 hour, even the hourly, we're going to find a really good area within this that's going to enable us to move our entry from up here to maybe down here or something like that. So we'll do that quickly. We'll start on the 4 hour and we'll have a look. Then if we're not satisfied, then we'll move down to a smaller time frame. Okay, so if we have a look here, you can see that we have the area that we marked off look like that. And you can see that we have a lot going on. Price rallied, accumulated, rallied, accumulated, rallied, accumulated, rallied. We came back, we tested this area. So as a matter of fact, I'm going to put this line at the edge like that. So we tested this one here, and we rallied, we accumulated for a pretty long period of time, and then we moved higher. So price left from here, but if you look from here, you can see that there's a lot going on just below here. And so what's important here is to ask yourself, okay, what damage did this area right here do? What happened here? What did it do? What did it consume? And you can see that we have some supply just here, which has been consumed, and that was consumed by this area here. And this is pretty interesting because see how price came down. We tested these lows, so we had a parent, child, older sibling. So we had this area that was marked off here, something like that. It was tested once, twice, and now it was consumed, it was taken out. Then you ask yourself, well, what area of supply is responsible for consuming this 4 hour demand? So you move it to that area. It's this one here, like that. And you say, okay, cool. Well, then you ask yourself, okay, is this one, has it been violated or is it still present? Then you can say, well, it's been consumed. Then you ask yourself, well, okay, what area of demand consumed it? It's this one here. So actually, we have a valid area of demand just above our daily area, because this is where everything left from. But before you get carried away and start clicking in right here, you have to ask yourself a bunch of questions, and that is the whole parent-child question. So it's kind of an iterative process. You find an area, you ask these questions, you find the area, this area qualified, you ask your questions, and if you do this, you will eventually reach the area of supply and demand that you want to trade. So if you look here, you can see that we have this area. Is this a parent or is this a child? Well, it's actually a child, and you can see this is reacting. I'm going to remove it. It's reacting to something in here. It's reacting to this one just here. The indicator's marked it off. So we have this 4 hour area, which is just here. So this is the 4 hour demand that is the parent. And this is apparent because on the leg up to it, this area was established independently. You can see it just tested the tops of this extended range candle, but this is apparent. It's not a super clear price structure, but it's clear enough. And if it's not clear enough, you simply go to the smaller time frames and you refine it. And then you can get a lot more clarity. And you can see here that we can see the story being told. You can see that here, as a matter of fact, we have price sold off, accumulated for 2 periods, it rallied, and it did not manage to come back. So that's good. So that tells us that we could probably have our entry to buy here, and our stop would go below here, because there's no real demand. There's no demand in here. There's nothing there. This is that we have demand here. Price has not been back to that level, so we could trade this one, but there's no, this is not demand. This is messy accumulation, and so you want to go lower. Okay, we have demand. The next area of demand is down here, like this, and there's nothing else. There's nothing else down there until we get to here, and you can see that when price left here, actually this candle goes straight through it, doesn't it? Yeah, so that's, I mean, that's not even, that's gone. There's nothing there. And so you have to keep looking left in order to move through to the real area of supply and demand. Okay, let's get some questions. Derek is asking, how does a currency strength factor into the decision? Really good question. And it factors into it quite a lot. Before, I mean, if people who trade supply and demand that don't look at currency strength, they have to simply trust their levels. And you can, if you do your analysis properly, you can trust the levels. But we have currency strength. It's a tool that we incorporate, so we're actually quite lucky. And so what you want to do is you want to identify your area of supply, of demand in this case. We have another one down here I can see. And instead of just putting your limit order in to buy, you wait for price to reach it, and you look at the strength information. And ideally, you want to see something like this. You want to see currency strength divergence going on. You see how we have price is moving lower, but the strength is moving higher. Price is moving lower, the strength is moving higher. Price is moving higher, the strength is not going that much higher. Here we have prices moving lower, strength is moving higher. So you'll see this absolutely everywhere. And you want, and while divergence is powerful, it's most powerful when the context is spot on. And it's spot on when it's feeding into an area of daily demand, 4-hour nested areas like it is just here. Excuse me. And so you want price to come in here. You want the currency strength to show you that the area is going to hold. And we can have a look here. You can see that price is moving lower, but strength is moving higher. So this tells us that we're probably going to get a reaction here, and price is going to begin to move further up here. So this is really good. But this also could be the first hump in a 2-hump sequence. So, which it probably is, because it's not really reacting on anything yet. So we're probably going to get one of these. Let me draw it in. So we're probably going to get price do this. We're going to get another one down here. And so the indicator is probably going to do something like this. So we have lower lows, lower like that. When price leaves, we will break a trend line, a downward sloping trend line, which is like that, which qualifies something down here as demand. And this is where you buy. And price goes to the moon, roughly. Okay, so currency strength is a phenomenal tool, and especially the histogram, because the histogram, instead of confusing with a bunch of colored lines, which is what I used to look at, this is only showing you the difference between the two currencies. So you don't want, I mean, a lot of people look at currency strength and they get a little bit confused, because currency strength is often showing colored lines where you can see the strength of one currency and the strength of the other. And while that can be useful, we don't really care about the strength of one currency and the strength of the other. We are only interested in the difference in the strengths of the two currencies. And that's exactly what this new histogram is showing us. It's a phenomenal tool, a really, really phenomenal tool. Okay, William is asking, could you look at the pound Kiwi? I thought that chart was what it was going to do. Sorry, it's really small, my chart. And they sold off big, maybe coming to that blue area now. Let's have a quick look. Okay, so were you buying or selling? So if we have a quick, let me just go up here on the weekly and see what's going on. Okay, so immediately you can see that we are reacting on some pretty important levels here. You can see that we have this our weekly supply. Oh, the pound kiwi, sorry, yes, sorry, my bad. Pound kiwi, here. Okay, yes. Okay, so we have this one here. So price is moving higher. So we go on the weekly chart and have a look. We're there. You can see that price is really screaming higher, and you can see that we have this area here, like that. It's going to mark the high of this candle because it kind of poked into there, so you don't want to be selling for a price any cheaper than that. And price went pretty deeply in, but you can see that before we get carried away, you can see that there's, if we look at the high here, it looks like there's some kind of a reaction just in here. So we're going to go to the daily. We're going to have a look, and you can see that we have a daily area nested in that, and you can see that we have a child, and the parent is here. But you can see that it's almost gone. I mean, this one has been taken out, and so the area of supply, the top of it, is at the 190.50. And so if price is able to move beyond the 190.50, then you don't want to be in there anymore. Then you want to be buying down here or at the area of demand that took out the whole area of this supply. Let me remove the rectangles here so that we have to do the work ourselves. Okay, so you can see that we have this area. We're just going to mark it off properly. We're going to take this one here, and the area is like that. So we tested the edge of it. It's pretty much gone now. So now it's actually this area that we're hoping is going to work, like that. It's tested it, and price is moving up into it. What about trend lines? Can we draw any trend lines? We certainly can. We can actually draw a trend line. That is above that high, I think. So we'll just take it from here just to be safe. So we have a trend line that looks like that. So we have a weekly. We have a daily uptrend because you can draw it on the daily chart. Daily uptrend. What kind of a trend do we have on the weekly? On the weekly, we have a daily uptrend, but I mean, we'd connect this low to this low, but it's so far away from price that it's not really important for us. But we look at this one here, you can see that we have a daily uptrend, which is great. So we have this area of demand located here at the 182.67. If we go to the smaller time frame, you can see that we had a very kind of a steep trend line here. We could maybe draw like that, which has been broken, which tells us that price is starting to break down, keeping in mind that we are reacting at weekly supply. So price poked into the weekly supply. We probably have some divergence here on the 1 hour. We had a high and a higher high, and we probably had a lower highs here in the currency strength. The price sold off, and now we're testing that in anticipation that price is going to continue moving lower. But on the daily chart, we want, did I draw that? Is that valid? Just to make sure. The high of this one, 88.753. No, we can't. This is not a valid trend line. We can't do that. So we have a trend line break. And this high is lower than this one, so this one is still holding. So I bet you if we go on the hourly chart, we can probably find an area here that is currently holding price. It's really messy, as we spoke about. This is not a nice area because there's a lot of trading in here. So that's not a super duper area, but we can see that we have something. I feel like a Philistine drawing it because it's not allowed, but I'm just going to show we have something up here. Like that. Price is testing it, and now it's selling off. And I bet you if we mark off the high here, and we scroll back, we can probably find the area of supply that that's reacting to. if we can get back there. That's one of the challenges with this. Oh, there it was. Okay, so we are actually reacting to this, and you can see that this is that leg down, and you can see all of a sudden we have a lot of interesting information here. We have this, we are actually, it's reacting on this. We had a nice move away. What about the structure of this accumulation? Is that pretty? Is it a short period of accumulation? No, it's not. It's a really horrible bit of accumulation. But what we do have, we have this right here. And price went back to about this area here. This is a really nice area. We'll move the stop up here. And now we go back to current price and we look, where are we in relation to that, what we just saw? You can see that that's located above it. And so you can see that, yeah, we might get a small reaction, but the real supply is still, 750 pips away. This is also a very volatile par, the pound Kiwi. And so we're probably going to get a pullback down to maybe something down here, this area of demand. And then price will probably continue moving higher. We don't really have any divergence going on at the moment. We can just see that the strength information is price continuing to drive higher. Also in price, if price does manage to move high, you want to see a divergence on the currency strength before you consider selling. Ideally, you want to see a trend line break that qualifies an area of supply for causing market structure to break before you're selling. And we're not seeing any of that yet. The market is still looking pretty strong, and I think that we'll see buyers re-entering the market when we come down here to the 182, between the 182.70 and the 181.40 area. This is a pretty decent area. So there's still it's still got some space to move, but we are reacting at this this little one in here, and so just keep that in mind. And then when you do the top down like that, you mark off these areas, then you have those reference points, and you're a bit like, okay, super, okay, I could take this trade, but due to this new insight, I know that we'll be buying into a weekly supply. We might want to wait for a bigger retracement to a more solid area of demand, which we have there on the daily chart, in anticipation that it continues moving higher until we get up to a proper supply, which we have here. We also have the flip zone here, where price tested here, then it went down. If we move, you can see it's here. It's a pretty good area right there. You see how price, this is a really important one here. See here how price rallied, accumulated. We had resistance, it rallied, accumulated below it, it popped through, tested it. Price will react here. Absolutely positively react right here. And this area is located just below. So you might want to even consider managing this trade aggressively or passing it and waiting for price to come here and taking the short down here, because this is great. You can see we had a parent child. This is the parent. And this is the one that took out the parent. And so this is the key area, I think, excuse me, for this trade. And this, I mean, it's really far away. And this is longer term. If you go on the hourly chart or the 50-minute, then there's going to be tons of trading opportunities inside here. But ultimately, you'll be doing the same thing, the same process, just on the smaller time frames. Okay, so that's what we have there. I better continue moving through the slides so we don't get too sidetracked, even though it's easy. Okay, so we have the nested area, which we kind of touched upon again, and that's just a matter of drilling down on the smaller time frames, or maybe paying attention to what the indicator is doing. And you can see here the indicator does it very nicely, where we have up here we have a weekly area of supply, and within that we have a daily area that's nested. And here we have a nice one at the bottom. We have this weekly area of supply, and you can see very clearly we have the parent and the child. So the weekly area would be telling us to buy at the edge of the child, and the parent would bring us down to the parent, which is the better entry for that. Okay, super. We kind of covered that. Let's keep moving. Accumulation. What is accumulation? Before we can talk about accumulation, let's define the term liquidity. Well, liquidity is the degree to which an asset can be bought or sold without affecting price. And another way to put it is the ability to sell an asset and immediately changing it immediately into currency. So there's no delay in the transaction. If you consider a very liquid markets, a liquid asset is the euro US dollar, the pound US dollar, and all of the majors during the London session or the New York session. Illiquid assets are rare comic books, wine, champagne, bars of gold, real estate, stuff like that. These are very, very illiquid. And why are they illiquid? Well, they're illiquid because they're very difficult to convert into currency. Okay, then we have accumulation. Accumulation is ultimately accumulation of filled orders in contrast to distribution of liquidity. So us being on the buy side, we are buying to increase price. But our broker, who is selling us liquidity, who is establishing a market for us, they sell in order to increase price. It's a little bit counterintuitive, but if you view it from their side of the market, then it makes perfect sense. They are selling something to us, to the market participants. The market participants buy, and this buying pressure makes the price of the asset increase. And so accumulation is just these patterns forming on a price chart in areas where liquidity pools are very likely to exist. And so the origin of these pools of liquidity is generally pretty clear on a price chart. So if we have a quick look, here we have a pattern that we've looked at numerous times on the charts already this evening, where we have a nice rally, 3 periods of accumulation, then a nice strong or relatively strong move higher. And so what's going on inside these candles? Well, inside these candles, price is actually moving up and down, filling orders. So I mean, actually I have another slide that shows this very nice and clearly. And so if you consider for a second what actually moves price, is it the orders that are filled or the orders that are not filled? Well, the price chart is showing us the orders that are filled. It's not showing us the orders that have not been filled yet, which takes us to this point here. What actually is it that moves price? It's the unfilled orders. Price will gravitate to through the thin liquidity and towards and into these pools of thick liquidity, which are the limit orders sitting in the market. Okay, so if we have a look on this next chart, you can see that, assuming that that this candle here is a daily candle, and it's this one here. So the day opens here and it closes here. So when the day opens, price enters the market. We have the thin market here in between, and price begins to move higher. Price moves through thin liquidity and seeks out the thicker liquidity or the pools of liquidity in the market. So it moves up, it finds a pool of liquidity here, which is perhaps a sell limit. It finds it, the order is filled, this drives price lower. It moves lower, it moves through the thinner side of the market, it finds liquidity here, buy limit, this pushes price higher. And the process continues up and down like that, and price will continue to move in the direction of the thinnest liquidity, and it will stop or turn around when it hits these pools of liquidity, which are typically the unfilled orders, limit orders residing in the market. So price moves up here, and we find this pool of liquidity just here at the 11300 area. We find some nice limit orders there. Price retraces a little bit. Profits are taken perhaps. Other people start entering the market here. You know, like resistance becomes support. People start to buy here. This brings price higher. And so once price moves through this price level, you can't buy this asset for 113 anymore. You have to pay 113.10 because the price has moved higher. It's no longer available for sale at this price. You have to pay the higher price here. And so price, rather accumulation, is the indicator looking inside these candles and looking for this pattern to occur. And they occur everywhere, which is why it's really important that that you incorporate context. Context is absolutely everything in relation to accumulation. Okay, so if we, for a second, consider this, we have the thin side of the market, You can see we have pockets of 10,000 units of an asset here above price, and here we have pockets of 200,000 units of an asset to the downside. So at the 79.25, there is a pocket of liquidity to buy here. That is 50,000. So if I come into the market and I have a buy order and I want to buy 50,000 units of this currency, of this asset, price, in order to fill my order, price will have to move up five price units. So from 25 to 79.25 to 79.45, because when I've consumed this, completely consumed this, I still have 40,000 units to fill. I have 30, 20, 10, now it's filled. And so my tiny order of 50,000 units was actually able to move price 20 pips. And this is ultimately what slippage is. And when you have a broker, a poor quality broker with a very poor liquidity, you will experience slippage all the time, because the bigger market participants will be consuming liquidity, causing price to jump up and down, consuming these pockets of liquidity, so you can't get it there. So the big trader in front of you buys here, you have your order to buy here as well, but their order is filled before yours, so you get filled in the next order here, the next pocket just up here, or up here, or up here. And so, yeah, the more people buy, the worse the price is going to get for this asset. On the contrary, on the other side of the market, we have the thick side of the market, and so this person sells, and price doesn't move at all. It hits this 200,000 units of this asset, which simply consumes this order. And so there's simply nothing happens. Price doesn't move at all. It doesn't even go down 5 pips. But when we were buying, then it went up 20 pips. And so this is, again, we have the thin side of the market and the thick side of the market. Okay, so we have, price moves higher when there's more demand than supply. So the buyers are capable of consuming the pockets of liquidity that are available to the upside, which drives price higher. In contrast to price, when it's moving down, we have very little buying. We have a lot of selling, and so it's pretty much this flipped upside down, where we have the thin side of the market to the downside. We have a lot of selling, as you can see here, and this eats the pockets of liquidity available to the downside, driving price lower. Okay. Okay, so accumulation, how did I learn about accumulation? Accumulation has been around, I think, for as long as the markets have been traded. It's just like a common term. I like to use accumulation because it makes sense for us being on the buy side of the market. But I learned about it trading currency strength on the very small time frames. And this is typically on the 1 minute and the 5 minute charts. Not recommendable. It's pretty stressful. And so I would study price at the open of London, so at 800 hours GMT, and I would watch what price would do in and around these time frames on the price chart. And I did this. I quit my job and I looked at charts for 8 hours a day for about maybe 6 to 8 months, and so I had ample time to study price and see what it was doing. And so this whole notion of accumulation in relation to different times of the day, the London Open especially, was incredibly insightful. It was a very educational period in my trading career, just looking at charts like that. And so, what does this look like on a price chart? Well, this is from my trading log, and I would look at currency strength like this. You could see that the open of this box is GMT, 800 hours. So this is London Open. Sorry, coughing a bit there. And you can see that prior to London opening, price moves up. We have thin liquidity. Price seeks liquidity. It finds liquidity, which it finds here, which is similar to, which is similar to what I don't know where it is, what we saw on the previous graphic, where price goes up, then it finds the limit orders, and then it starts to sell. And this price goes down, it goes up, goes down, it goes up, it goes down, up. This is accumulation happening. And price is accumulating. Here you can see we're slowly digging deeper. So we're buying we're selling, so we're buying, we're filling short orders here. This drives price lower. We have a small price imbalance, a price inefficiency, which has to be filled, which typically fills. So price will gravitate through the thin liquidity, and this is thin liquidity, this is thin liquidity, this is thin liquidity. We have it here, we have it here, it's everywhere. And so when price leaves an area of accumulation like so, supply, when it leaves, price will almost always come back to rebalance price. Why? Because the thicker liquidity, the bigger limit orders are up here. They're not in here. They're not here. There isn't enough liquidity to drive price lower here, so price has to come up here to the thicker liquidity to seek the liquidity, the short orders, the limit orders that will drive price lower. So the indicator is looking for this and paints the candles white. And so London opens, it starts painting white candles. It was in a separate indicator at the time, and then it starts to move lower like this. Then we have 15 minutes into the session. I discovered that between 15 minutes and 30 minutes after the London Open, this is when price really moved. And any moves prior to that was Frankfurt, like small trading, very, very early London, before the London Open. And this was simply, this was more often than not like forced breakouts. So it wasn't, I made a rule that would stop me from buying or selling before 15 minutes into the session. Anyway, London Open, London gets going, the traders get to their desk, the institutional traders, they start filling the orders on their books, either an interbank or they do it locally, and then they get these big moves. And so you could see down here we'd have demand for the Canadian dollar, we'd have supply of the euro. The Canadian dollar strong, the euro weak, would bring this pair down. So I'd wait for price to pop out of the box. We'd have this nice price, this price imbalance, thin liquidity, thick liquidity is here, and I would sell once price poked back into the area of supply where the rebalance had been complete, and then I would follow it down until this strength information would turn around and tell me that something else is going to happen, which you can see it started to do on the short term just here in the middle. So accumulation, I learned about simply by watching this over and over again in the mornings. If we have a look at another example, you can see that we have the London Open, we have 15 minutes into the session, we have the Australian dollar, which has been strong throughout the entire course of this. 15 minutes into the session, price pops out of the box. We have a price imbalance. Price comes back, rebalances that. It seeks the liquidity. It's thin here. It's thicker here. Pokes into the thick liquidity. And I know that I'm buying. I know which side of the market is thinnest, which is to the upside, because I know that I should be buying the Australian dollar and selling the American dollar. We have demand for the Aussie, and we have supply of the US dollar, which draws price higher. Okay. So where is the thicker or thinner side of the market? Well, you can use currency strength to show you this. And as we saw here, you know that the thinner side of the market is to the upside. So price is not able to consume the liquidity to the downside, so it has to move to the upside, which is a path of least resistance. So currency strength will show this to you, which is why currency strength is one of the tools I like to incorporate in my trading toolbox. And you can see here that we have demand for the Swiss franc and for the euro, and we have a supply for the US dollar, Aussie dollar, and the Canadian dollar. And so you want to pair these currencies accordingly and trade those at supply and demand. Like you can see here, I know what currencies I'm going to be trading. I'm going to be buying the Aussie dollar and selling the American dollar, and I know where I'm going to be buying. I'm going to be buying at demand here, which is at the base of this price imbalance, as you can see. Okay, and so here this is just an example of one of the indicators. I'll just flick it on here quickly, which you guys also have. And so here, you can see that it's working hard. It's kind of after hours now, so there's not a whole lot going on, but you can see that, the Swiss franc is in demand, and we have the Australian dollar. There's a bit of supply there, also with the Japanese yen. And so this is also telling us very clearly what's going on. And so ideally, when I sit down at my desk in the mornings, if I'm going to be trading shorter term, I'll put the indicator in a shorter term. Let me just do that. So I'll put it on, for example, day trading. So this is shorter term intraday trading, and I'll look. I'll say, okay, what's being bought and what's being sold. I can see we have the Japanese yen is being sold and the Swiss franc is being bought. So if we bring that pair on the chart, franc, if I can find that franc yen, this should be moving higher. And you can see it really is. It's absolutely roaring. So this is going to be more visible on the smaller time frames. So if we go into the 50-minute chart, then you can see, yeah, it's moving nicely higher. So it's crawling ever so slightly higher. It's also out of the sessions are kind of closing. I think the US is kind of wrapping things up soon, so it's not as profound as it would be during the London or the North American opens. But you can see just very clearly what's going on. You know exactly what you should be buying and what you should be selling. And so this was my whole motivation for developing this this software. Okay, so analyzing a pair chart. I mean, we can do this in two ways. We can do the full analysis, which I recommend, or we can do the quick analysis, KISS, keep it simple, stupid. And it's just a matter of, actually, I have a diagram on one of the following charts I'll show you. And so what we do when we do the full analysis is we consider all the things that we've looked at previously, where we look at, we identify the area based on the way price leaves. Then you ask yourself the question, is this a parent or is this a child? If it's a parent, it's great. If it's a child, where's the parent? Because typically the child will be a reaction to the parent. And so the demand or supply is in the parent, the child is a reaction to that. And then we'll draw all the valid trend lines. We'll grade the accumulation based on the checklist, and then we'll ask ourselves where has price not been, and where is the next pancake? And the next pancake is just something I refer to. For example, if you look at this here, you can see here we have a child, price poked into here, and so I refer to areas of supply and demand as plates of pancakes, where the top, this is a plate, the first pancake on this plate is located at the top here, and this poke in price is a fork. And so the first pancake on the plate has been taken, and so the next poke and the next pancake is located just below that, and so price is going to have to go a little bit further down to get that one. And so the next fork, parentheses, move in price, will have to come lower than this move in price in order to get the next pancake, which is essentially the next pocket of liquidity. Okay, so that's why the pancake thing. I like pancakes. And so what I like to do is we'll do this. We'll just do an analysis of a price chart. Let's have a look, and let's consider here for a second this. Okay, so we're going to be. This is shorter term. We're going to be buying the franc, and we're going to be. Yeah, this is kind of out of hours because you can see they're swapping out all over the place. Let's put a more profound configuration on there. We'll do this, and we'll do like that, and then we'll get some more solid levels. Okay, so we have in the Euro CAD should be moving higher. So let's have a look at the Euro CAD and find a place to buy Euro CAD. Okay, and so the Euro CAD, you can see if we're swing trading, our long-term time frame is going to be the weekly. Our medium term is going to be a daily, and our entry time frame is going to be the 4-hour. And that means that we can enter trades on the 4-hour time frame or less. We might have to go less in order to refine our entry and find those nice nested areas. And so on the weekly, we're moving higher, very much so. On the daily, we're also screaming higher. So on the 4-hour, we have to identify our areas of supply and demand, or in this case, demand. So we draw our trend lines. Let me remove this. Sorry, wrong one. Just don't want it to do trend lines. So you can see that we have a valid trend line here. I'll just draw it in. So we have the first point. second point, we have our high, price moved above, so we can draw a trend line like that. So I just draw that in. So something like this. So we have a very clear uptrend on the weekly chart. And if you look here, you can see we can also draw a downtrend, which is very important for now because we are buying. And so we have a high, we have another high, and what do we have? We have a broken trend line. So we have market structure failure, which is really nice. And you can see we have an accumulation candle just here. So we want to be buying. We have an upward trend on the weekly. We have a downward sloping trend that is broken, which means buy, buy, buy. We go to the daily chart and we'll have a look. We'll do the same thing again. Our trend line on the daily would be the same trend line, so we can just leave that one here. And you can see that we are approaching an area of supply here. You can see the edge of the monthly. We're pretty far into this daily and weekly supply here at the top, but we want to be buying. We have a lot of reasons to do so. And if you look here, you can see that we actually, on the 4-hour chart, we want to be looking for places to buy. So we want to be looking for these really nice moves away from accumulation. You can see there's not a whole lot, nothing's very clear here. You can see that we have a gap here, and this gap was pretty much closed. We have this tiny area of demand here. It's been tested once. And so what we could consider doing is, it's not a very pretty situation. You can see that there's not a whole lot, it's not a very clear area to buy. And then you can see that we had accumulation, very ugly, price came down, and then we poked into this area of demand, which is just down here. But it's not a very pretty area here. So what we could do, we could take some shorter term trades at areas like, for example, this. We had price kind of move down, accumulate, and then rally higher. So we have the 140, around the 14600 area, which could be interesting, keeping in mind that we'll be buying into a greater period supply. So we might want to manage this a little bit carefully. But then you want to do the whole checklist thing and ask yourself all those questions. Is this a parent or is this a child? Well, this is pretty much independently established. We're reacting potentially at the very highs of this. I think more that we're reacting to the highs of this over here. So we're reacting to this over here. So this is actually the flip, kind of the flip zone here, how we have kind of resistance becomes support. And so I think if price comes back down to this area here, resistance will become support at a later stage, which overlines nicely with this this micro area of 4-hour demand. So we have something like that. So that's pretty much how I'm doing it. And if we have a look at it, we'll do another one example. Let's maybe do. We'll do it without currency strength, and we'll just have a look at the swings. If we have a look here, you can see that, let's do the smaller time frame. So if we have the daily chart, so the 4-hour chart, this is our trend. So we're looking here, and you can see that we're moving up. We have highs that are getting taken out and demand that is being respected. So we take from this one here to this one here. It's probably the nicer ones. And that looks pretty good. So price is moving up, continuing to move higher. So we have this. This is the medium term. We want to do the same thing. Have a look here, and you can see that we have this low. We can connect it to maybe this low here. Kind of the same angle. It's still looking the same. So price is continuing to move higher here. And so ideally, we want to be buying at demand. And you can see this is, if you go to the 50-minute chart, then you want to be looking for this. And so a really good way to identify demand, like properly qualified demand, is to, and we spoke about this earlier, qualified demand. So consumption of opposing qualified supply and demand. So you want to find an area of supply or demand that is qualified. And we'll just find one. This one here, it's not a very pretty one, but it's a nice one because price had rallied, accumulated, then rallied, and it was tested once. On the second test, it got torn out. Then you ask yourself, what area of supply did that? It's this one here. You ask yourself, is this a parent or a child? It's a child. The parent is here. You move it to the child, the parent. Okay, is this one still valid? No, it's not. It's been taken out by this one here. Parent or a child? It's a parent. You ask yourself all those questions about the quality, depth of the curve. It would fail. Why? Because it's way too shallow. So you go to the bottom. You say, okay, is this a parent or a child? It's a child. The parent's here. Parent or a child. You could probably get, there's probably a parent in here that's looking like that. Something like that. It was tested. So this one is still holding. So this is still a valid one. And I bet you inside here, price is reacting. And this is actually reacting to this over here. And so, I mean, this led us to this, and now we're here. But if you do your whole parent-child thing, if we go to the 5-minute chart, we can probably see that, okay, this is actually a child. The parent is down here. So this is the right one. It's been tested once. This is a pretty decent area, I'd say. The 130, around the 136.90 area. You can see, okay, is this a parent or a child? It's a child. It's reacting to this parent. This is a continuation pattern, so we could either mark that off and, sorry, go like that and see that it tested there. Then you ask yourself, okay, is this a parent or a child? It's a child. Okay, where's the parent? It's here. Okay, how did price react when it came back the first time? It reacted really nicely. Price really flew higher. And so that enables us to be able to trade the parent again, simply because the way price left. And so for this, we would put our entry in here. We could maybe leave the child on there above just to see. The entry is there, and the stop is just below here at the 136.67. So this is the area that we want to trade. And we identify that by starting here. And so it's super important that you ask yourself these ever so important questions. And you never cut corners, because when you cut corners and you say, okay, I think I know, or I think this and that, if you think too much, then you end up doing it wrong. So it's really important, at least for me, to ask these questions and backtrack until I find the right area, which we've done here. Do we know, will this hold for sure in the future? We have absolutely no idea. It may or it may not. If there's news being released as price is approaching it, then you might want to take off the order and wait until until the news comes out, because when the news comes out, liquidity will dry up and price will have to seek liquidity, which is typically located very far away from price during news releases. So price can jump up 100 pips and down 100 pips. And so the whole supply and demand trading model goes out the window during news. Unless you're identifying supply and demand areas that are very far away from price during the news release. Okay, so we have this one here, which looks pretty interesting. And so, I mean, we have this, and then we have a quick version, and the quick version looks like this. So you pick a pair. This can be based on your currency strength analysis. You go to the entry time frame. You zoom out all the way, and I'll just do this one step at a time. So we'll take the Euro USD. We'll pick a pair. Let's say that we are going to be, our entry time frame is the hourly. So our trend is the daily, our medium term is a 4-hour, and the hourly is our entry time frame. Just going to remove these lines, so we have to do the work ourselves. Okay, and then you zoom out all the way. Then you go back. Are we going up? Are we going down? Are we moving up? We're going down. We're moving higher. So price is actually moving higher. Okay, are we close to a top or a bottom? This is just a filter. So what we can do is I'll typically mark off it like that. And I'll go to the daily and I'll assess, okay, how close am I to supply or demand? Getting pretty close, but there's still a bit of room. There's still a bit of room there. Okay, so I go back, look for extended range candles. So you've got to look for the green one. You can see there's a green one. You can see that we have one here. So you mark, this is better here. This is okay. It's been tested once. We have a couple there. Like here. It's a tiny little entry or area. So we have that one there. It's been tested once. Will it work again next time? Maybe, but each time, each consecutive test of an area of supply and demand reduces the likelihood that it's going to hold in the future. Do we have, what about this one? Is this one okay? Yeah, we could use that. You can see this one is reacting on this one here, and this one is reacting on this one here, and this one is reacting on this one here. So you have to backtrack a little bit. But you can see, because we have the gap, we still have to close the gap, and the gap is not closed yet. And so we could ideally put this like that, and trade currency strength divergence once it comes back into here, if it comes back into there. So we've identified a couple of green candles, identified the area of accumulation. So we have this area of accumulation here, we have this one here, if this is the one we choose. Is the accumulation messy? If so, smaller time frame or pass. This is okay, this is messy. So this one is fine, we don't want to do this one. So you might want to consider looking at somewhere else. You draw the areas like we've done here. Place your entry, stop, and target. So we'd buy the 109.17, stop just below, and the target just above. This is not a perfect entry, but I just wanted to kind of show like the really quick way of performing the analysis. I don't recommend doing it this way. I don't do it this way. I like to do the complete way because it's number one, it's fun. Number two, it's really good practice. And number three, repeating something over and over again eventually will make it become, it'll reinforce your beliefs about the supply and demand currency strength trading model. So if you do it again, over and over again, and you watch how price reacts at these levels, it'll simply be confirmation that this stuff really works, and then you'll be it'll just be a lot clearer and a lot better off. Okay, so that was the quick version, which I don't recommend. Good. Just to wrap things up, and then we'll just I just run through these quickly, and then we can do perhaps a quick Q&A afterwards. Okay, so there are 3 ways of assessing, identifying supply and demand, but we use the 2 because those are the best ones, and those are the ones that we discussed earlier. We talked about accumulation and what it was, and why it's important to us as traders. And I think if you understand accumulation enough, that will really increase the likelihood that you're finding some pretty decent areas at which to trade. We looked at 2 ways to trade. You can do the complete analysis, which is of course highly recommended, and the quick analysis if you want to cut some corners. Yeah, and I recommend focusing on one thing and doing it well. And that one thing could be qualifying areas of supply and demand using trend lines, for example. It can be qualifying areas of supply and demand using the rule number 1, which is the consumption of opposing supply and demand, simply by marking off an area as we did, and then backtracking as we did, in order to find that entry that we found on the 15-minute chart. This is a really good way to identify that, and the more you do that, the better you'll get at it, and then you'll be really, really good at it. And so, I mean, I'm presenting this stuff to you, and I'm showing you how I do it, but maybe it's not the way that you want to do it, and you don't have to do it. You shouldn't do exactly what I say, or what your colleagues are saying, or what Michael's saying. You can take all the stuff that people tell you to do, and you can study it, and you can apply it to the charts yourself, regurgitate it, look at it again, chew on it a little bit, digest it, and then eventually your own model or interpretation of what it is that you've seen other people say will come to the surface. Then you skim that off the top, and then that's your gold, and that's the way that you should analyze the market. I mean, we're all different, so it's impossible for someone to teach me how to do something and me to do it exactly the same way and expect to achieve exactly the same results. It's completely impossible. because I mean, we are completely unique individuals. We have we all have our own set of beliefs and values, and this is of course going to affect the decision-making process when we're trading. And so I really recommend just finding something that that resonates with you in relation to the stuff that we've spoken about, and just practice doing it. And eventually, in a couple months, maybe even a couple days, if it really speaks to you in the right way, then you'll be a master at that. And then you can take that and you can teach it to one of your colleagues, one of the other guys or girls on the team, and also teaching something, getting up to a whiteboard and explaining it, and being scrutinized by your peers really helps you think about what it is that you're presenting. And I find, as a matter of fact, I find teaching, doing these presentations incredibly insightful, and I really recommend doing that. So you learn something, trading supply and demand, and you teach it to, let's say, 5 people within the next month, and I think that that'll really help make it stick. Cool. All right, so rambling on for an hour. Let me unmute you, Michael, and then okay, now you're unmuted. Now everybody can hear you, and now we can perhaps do like a couple of questions if you guys want, or okay. Michael is asking, do you prefer to stay on the side of the daily trend, or do you trade both supply and demand within the micro move? It depends. Normally, I know what the trend is, but I won't always respect it. It depends on what's going on. It depends what's going on the time frame. Sorry, my screens are just blinking and going mad here. Okay, and so it depends. I like to know what the trend is, so I can choose to make the better trading decision. But if I see a really nice area of supply and demand that is in opposition to the trend, then I'll still take it, but I'll manage it slightly differently. Okay, Stephen is asking, how is strength defined, measured in the histogram? A really good question. I'll show you. Okay, let me. Okay, can you still hear me? My headphones just did something strange there.
Yes, we hear you.
Yes, okay, cool, good. Okay, so the histogram is, what it's doing is, we're looking at the euro US dollar now. Let me remove some of these unwanted currency pairs. So what it's doing, it's looking at these 28 currency pairs, and it's looking for all of them where the euro makes up a part of the cross. So you can see the euro US dollar, it's here. It's going to look Euro Aussie, Euro Franc, Euro CAD, Euro Pound, Euro Yen, Euro Kiwi, and so on and so forth. Then it's the same thing for the American dollar. Then it'll find all of the crosses where the American dollar is makes up a part of the cross. And then it'll perform analysis on each of those 7 pairs, which will result in a value for each of those 7 pairs. And then it adds those values together, and so I get an index, and it'll do that for the euro and for the US dollar. And so I actually have an index for the euro, and I have an index for the American dollar. And I'm subtracting the index of the dollar away from the euro, and that gives us the histogram. So this is not showing us the strength of the euro or the American dollar. It's showing us the difference between the strength in the euro and the American dollar, which is much more important, because you can see, yes, of course, I mean, the strength of the euro is really strong, the strength of the American dollar is very weak. I want to buy the euro and sell the American dollar. Yes, but perhaps the euro US dollar is overextended, perhaps is exhausted. We've reached the range, and now it's going to start moving in. You can't traditionally see that looking at 2 lines, one representing the base and one representing the cross. But when you look at the histogram, you can see when momentum begins to slow down, as we've seen here. You can see here that price is moving lower, so if you're looking at the squiggly lines, the colored lines, you can see, wow, the American dollar is really strong, the euro is really weak, it's moving down. But you can see here, when you look at the difference, you can see it's slowing down. It's slowing down very quickly. And then you have that really nice push away from the area, then you buy here at demand. Just a really good example. But this is pretty much what what's going on in the histogram. David is asking, does the zone lose its strength if price takes too long to return back to that area? It can do. If you have an area like, let's say we have an area here. So price comes up to it and then it leaves. If price, but what we like to see, it's really good if price manages to kind of poke into it and then move down. Because if price manages to reach an area down here of opposing demand and accumulate orders and then start to move up like this, then there's danger that this area is going to get taken out by this move. So you either want to take the release of the area, or just make sure that you're, to avoid trying to pick tops and bottoms. But if you're doing them, go down to the 50-minute chart and get the most extreme areas, so that you're getting the best possible price for your for the asset. Okay, William is saying euro Japanese yen is in a sell zone now. Let's have a look. Let me turn off this colored pencil. Yes, so you go to the weekly and see, you can see, yes it is. It's like sitting in this this weekly supply. You can see. So we zoom in a little bit, you can see that it's touching in here. So, okay, we have supply. Is this a parent or is this a child? You can see it's actually a child. The parent is over here. So you can actually see that price has been back to this level. In the past, you can see that, yeah, these are kind of poking up here. This tells me that the supply is above. And so if we go like this, we'll go like that, just initially. Then we go to like the 4-hour chart, and we go over, and we can probably see what's going on. You can see that, this is where price is tested historically. You can see it's been back a lot since then. And so ideally, you want to find the price that price has not been, a price level price has not been back to, so you couldn't. So actually you can see there's a small, okay, we have a small daily area just here. And there's a 4-hour area nested within it. So you could do this, which has almost been tested previously. You can see that that's, again, we're not picking a top or a bottom, where we drilled down and we found the most extreme area that we could, excuse me, that we could sell at, which is just here. But again, you want to see if price is reacting to something in this extended range candle here on the way down here. So maybe it's just reacting to these lows here. So this might be another decent area to sell at the 124.69, which is about 100 pips away. And then alternatively, you could look up at the top here. We have this weekly area, it's been tested at the bottom. Then we have these accumulation candles here. You have the green candle, you have this accumulation candle. Is the body of this candle within the range of the previous? No, it is not. So here we have actually two sets of accumulation candles that are not related. So we have a rally, accumulation, rally, accumulation, rally. So we can actually put an entry to sell also around here at the 125.80 area. So yes, we're definitely getting close to an area to sell. And if you, you could try and pick a top here, but it's not a good idea. Or you could go to your entry time frame. So if the daily is your trend, you go 2 time frames down, and you wait for a trend line break to occur. And it's a pretty slow crawl, so it's trading pretty relatively efficient. So you just wait for trend line to break, really poke into some thick liquidity, and then dump, then sell the supply that broke the trend line. Excellent. Cecilia is saying, but CSI is going up. Would you still sell? Yes, well, by the time, you can see here on the 4-hour that we have prices really moving higher, but the currency strength is doing something different. We have divergence. We have higher prices but lower strength. So the euro is losing strength in relation to the Japanese yen. And so I would expect price to, within the next couple of days, start to break down unless something majorly fundamental enters the market, and maybe maybe have a sell of like a sloping trend line break here. Just because of this, this is telling us that the momentum to the upside is slowing down. So yes, I'd sell, but I'd wait for confirmation. Excellent. Cool. Hey, Michael, can you hear me?
Yes, I can. I'm enjoying this as everyone else is.
Sleep. Yeah. Are there any other questions about what we've covered today? Is it interesting, or is it difficult or complicated? Is there anything specific that's that you maybe you're having a tough time with?
We've only lost 3 attendees since we started.
The index
I think we're doing good.
is equally weighted with all the other currencies. I'm currently looking at a way to incorporate a weight to weight it, but it's not entirely trivial. I'm just going to put some. Yeah, sorry about the coughing. You got this plastic cough. I've had it for ages.
Don't go to Bali anymore.
Very eye-opening. Understanding liquidity really opened up a lot of things for me. I'm so pleased. It really does. The whole point of understanding liquidity and what it means in a marketplace is tremendous. Hey, Brian, it's an absolute pleasure. Okay, William is saying identifying the zones when lots of areas is difficult to understand. It is, and so what you can do just to help in the process is in the indicator. We discussed the indicator in great detail last week. What you can do is you can set the supply and demand significance up to at least 10, and this will remove a lot of the noise. And you can even put it on maybe 15. 10 should work, but 15 is fine, and it's going to remove a lot of these areas, and it's going to show you only the really good ones. And so then you'll be forced to bring your attention to the good areas of supply and demand only. And you can see here we have like major swing highs. Here we have nice supply here and here, and so price is definitely going to react at all of these. And so you can certainly turn that down if it's a little bit too noisy. Joseph is asking, since someone raised a news question, what are your rules or thoughts on red flag news? A good question. I find that if I'm trading on the very high time frames, I'll normally leave my order in if I have a pretty decent stop. But if price is approaching my entry just before a red flag news release, and I'll normally move it to the area of supply and demand that is one step further away from price, simply because when liquidity dries up, price can go absolutely mental, and it's just good to be an observer of the market instead of a participant during situations like that. Yeah, Dave is saying, I never understood why news moves so much. It's simply just looking for orders to fill. Exactly. If it's bullish news, I guess price will just have to move low until it finds a thick pocket of liquidity before going in the way of the news. That's exactly right. That's exactly what's going on, because when the news is pending, big red flag news like interest rates and stuff like that, people pull their orders, and so it's too risky for the brokers to provide liquidity for sale anywhere close to price. So they'll put it in extreme areas of the market, and so price generally has to move very far to find these big limit orders that are located all over the place, which is why price often moves very far during non-farm payrolls, something like that. Okay, Brian is saying I have to review accumulation again. I think I've been looking at it the wrong way. Okay, if you have any questions, please feel free to ask Michael. I think Michael has a really good grasp on accumulation as well. Do you have a good day trading plan? Do you just look at higher time frames and trade that move, use indicators? Yeah, well, I normally look at the higher time frames, and I really like the whole set and forget mentality, but I'm slowly moving away from that simply because I've been burned a little bit too much. You have an order in the market, buy or sell, you get filled, price moves against you for a while, and then eventually it kind of works out. I don't like that. I'd rather get in at a clever level and wait for price to hit a level, wait for it to respond, to prove that it's going to change, and maybe look at strength information to see if a given area is going to hold or not. Carlos is saying he's having a bit of a tough time with the parent and child relationship. Yeah, I mean, ultimately, it's simply a way to assess whether an area of supply and demand has been established independently, or it is a reaction to another area of supply and demand. That's pretty much all it is. And the only reason I use parent and child is just to highlight that there is, to emphasize that there's a relationship between the two. Yes, I agree. I think long term is it just calms things down. When I was trading on the small time frame, man, it was very tiring, really exhausting, and I just wanted to get away from that. So the long term is just a better way to trade, I think. But it suits me. But someone else, I know a woman who trades the 50-minute chart, and she's got about 98% accuracy. She's an animal. And she does a really, really good job doing the super small time frames, and she doesn't want to be on the higher time frames. Joseph is asking if the parent-child relationship is reflective. What do you mean reflective? No, okay. Yeah, it can do. I mean, you can see where, I mean, the big orders are located in the market simply by the way that price moves. You can see, for example, here on this Euro-Yen chart. I mean, this looks like a pretty strong area here. We have another one here, which is pretty strong. How price went up. We found something in here, and then price dumped. And you can see this pretty clearly. And so if you do the whole parent-child relationship thing, then it normally brings you to an area that's a little bit better priced and where the smarter money is likely to be located. Excellent. Good stuff. Are there any more questions before we wrap things up for today? Hey, thank you, Derek. It's an absolute pleasure to be here. I really enjoy these. I'm glad that you're seeing value in the material.
And it's 1 o'clock in the morning in Denmark, isn't it?
Hey, thanks, Joseph. Thanks so much. Thank you, David. I'm not sure if Michael. It looks like Michael's gone home. So I think that we'll just wrap it up. Thank you, Hanetta and David. But this is going to be recorded, and I'll post this. I'll upload it probably tomorrow when I get up, and I'll send Michael the link so you guys can review this, so you can see it. And again, if you have any questions about this stuff, just you're more than welcome to contact me or Michael, and I'll get this stuff resolved. I'm glad you enjoyed it, Hayden. It's super interesting, isn't it? Also, when you look at it through the eyes of supply and demand and currency strength, it changes everything, absolutely everything. Your understanding. Now you think more like an institutional trader now than a retail trader. It's fascinating. And I mean, the main reason for me to focus on currency strength and supply and demand is via my conversations with institutional traders via my line of work, which is IT security. So I spend most of my time sitting in banks doing security assessments of software mostly related to trading and hedging and the fixed protocol. And so I'm exposed a lot to traders. And so, of course, I ask a lot of questions, and they talk a lot about supply and demand and the strength of economies, which can be converted to the strengths of currencies. So this is my motivation for focusing there. No, I don't look at divergence on MACD anymore. I use the currency strength histogram. That's kind of replaced MACD for me. You're very welcome, Cecilia. I know it's a bit overwhelming, but it's really, luckily, it's quite simple. It's just a matter of maybe watching the video, maybe another time, maybe taking like one piece at a time, looking at the charts with that knowledge, and just kind of going through a little bit at a time. I think, excuse me, in a few weeks, I think you'll be understanding price a lot. You'll be seeing things that you didn't see previously. So it might seem overwhelming, but it's not. Luckily, it's not complicated. It's pretty simple stuff. It's just a matter of practice, just like anything else. Yeah, cool. I'm pleased, so pleased to hear, Hayden. That's brilliant. Well, you guys have a tremendous opportunity. I mean, Michael, and bring you all in like that, and really kind of putting you through this educational material. It's a dream come true. I wish I had an opportunity like that when I was starting off, because you can really easily kind of be led astray and spend a year or two, or sometimes 10, studying the wrong stuff, and then come back maybe 3, 4, 5 years later and realize, oh wow, that whole like moving average stuff or Bollinger Bands, well, that was a complete waste of time. And then you realize that, I mean, this is perhaps a little bit more useful to you than the other stuff. Cool, excellent. Well, I think I will wrap it up. It's 1 o'clock in the morning here. I'm gonna go jump in bed, but thank you all so much for being here. Thanks, Brian. It's an absolute pleasure. I really enjoy doing these. But if you have any questions, like I said, please send them to Michael, and he'll fire them off my way, and I'll absolutely positively get back to you, and I'll help as much as I can in any way. But you've got really good support. Michael's a super chap and very supportive, so I think it's you're all in very, very good hands. Good stuff. Listen, thanks everyone once again, and I will see you all next week in the next webinar. Thank you so much.